Rupen Rajguru is with us. He's head of equity investment and strategy at Julius Baer. Rupen, good to have you with us here. Thanks very much. So we've got officially now, I don't think we needed the assurance that the mid-cap index was at a new high because, well, stocks have been making new highs, but the index is now at a new high. So it's still, I mean, so much, the breadth of the move is so wide, right? What happens is it loops in more and more newer, smaller sectors in. Like, for example, insurance out of the blue. I don't think anything new is happening in insurance. New India Assurance, there's GICRE, the reinsurer. So all kinds of moves here. So do you stick to the core portfolio or start to look for newer ideas here, Rupen?
Yeah, hi. Afternoon, Prashant. As the old saying goes, best of, or rather worst of mistakes are done during best of times. So we have to be aware of it, and history often rhymes. One of the key factor which is driving particularly a big momentum in mid and small and even micro caps is clearly liquidity. So there are two aspects to it. One is the overall domestic liquidity, which was always pretty strong. So that was there. But in last 5 months, what we have seen a deluge of liquidity from the FPIs. So while the FPI flow essentially comes into large caps, and that has led to buoyancy in the large caps. So typically, a lot of the flows of HNIs, retail gets into mid and small caps. In fact, as per the latest AMFI data, a record number of new folios have got added into small cap funds. The size of small cap funds are 20, 30, 1,000 crores, mid cap, small cap funds. These are huge. So essentially, whenever the liquidity is very high and ideas are limited, you tend to get down into the quality curve, or you look into relative plays. So I would say at this moment, clearly we expect, one should be cautious towards, the kind of huge run-up which we have seen in some of the mid-cap, or particularly small-cap, micro-cap names. Definitely, we have seen this movie played earlier, so we have to be cautious, and probably on corrections, I would be bar into that segment, but at this moment, would be a little bit cautious.
All right. Hi, Rupen. Good afternoon. Rupen, I wanted to ask you about capital goods. That as a space has come back in style. And, the street is quite bullish on manufacturing and capital goods. You think that it's time to take money off the table from here on?
Yeah, hi, afternoon, Nigel. This one theme which has done phenomenally well in this bull market of last, say, 2 years or post-COVID is the manufacturing and investment theme. And I think that's the theme has come back into vogue after 10 years of lull, right? It peaked out in 2008 and thereafter till 20 did not do anything. So typically in a cycle, what happens, Nigel, initially, it starts with the order flow, which is what has happened, and then leads to operating leverage. The margin goes up 2x, the ROE goes up to 3x, and the stocks goes up 3 to 4x. And that is what we have essentially seen in that segment, right? A lot of the stocks have gone up 3 to 4x in last 2 years. From here on, what we believe, that low-hanging fruit of re-rating is over. Some of these stocks, and in fact, if I were to add defense also into this play, from initially 10, 12 PE, all have gone into 30, 40 Ps. From here on, the stock price will mimic the earnings growth. So far, so good. No complaints. Earning growth has been there, and that's why stocks are witnessing momentum. But we have to be cautious that if that gets into a speed breaker, that is, the earnings growth does not come through, that segment is vulnerable for derating. So the way I would look at it, Nigel, if earnings growth comes through, the returns will mimic the earnings growth. But if the earnings growth does not come through, actually we might see a negative return by way of derating into this stock. So I would say we play into those stocks wherein there is a comfort on earnings, as well as because valuation comfort is probably not there, but look into the segment where at least we have an earnings comfort.
So, Rupen, that leads us into the next question, right? The earnings comfort. Consensus is currently pricing in about a 15 to 16% earnings growth for this year and next year. But there are many experts who believe that there could be some earnings downgrades in store and the actual earnings growth could be closer to 10 to 12%. So how comfortable are you with the earnings, from here on? Because in Q1, the top line growth was not that great. Nuvama did some analysis and they said, they'd analyzed all the BSE 500 companies and the revenue growth was just 6%. Part of it was driven due to price deflation, but just 6% top line growth and 30%. That's the breadth. 30% of them actually reported a revenue contraction, and the fear is that could, get worse going ahead. And plus even margin expansion, right? How much more from here on? So quite few people are calling for earnings downgrades from here on.
A good observation, Reema. And here I would say, if before we get into how do we see it, if we step back in last 3 years, for I think the top 500 companies at an aggregate level, the earnings actually has doubled. I think pre-COVID it was 5 odd lakh crores or 5.5 lakh crore, and last year it was close to 10.5, 11 lakh crores approximately. So it has actually doubled. So we have compounded the earnings more than in 3 years around 23-24%. We have compounded the earnings. From here on, we have to look into what are the growth engines, right? Because ultimately earnings growth is linked to the overall growth in the economy. And in economy, if we split into 3 parts, essentially the domestic consumption, investments, and exports, right? So I think nobody's questioning right now that the investment is pretty strong. So we have seen the early cycle, we are in the mid cycle. So the investment story should be strong. Within consumption, if we break down into the urban and rural, urban and probably high-end consumption is doing, high-end is doing exceedingly well, urban is doing okay, rural is struggling, expected to pick up. Exports is where we are seeing, globally there are challenges and that is getting impacted. So all in all, to answer your question, while the consensus is actually is spending almost 20% earnings growth for this financial year, clearly I would say that is vulnerable for some kind of downgrades. That is what we might see as we move along. But do we see a big downgrade? I would not believe so. So we believe that still we would get into, from next 3-year perspective, 13 to 15% earnings growth is very much possible, because the financial system, both at a banking level as well as at corporate level, is under levered, and I think that leverage will help the overall earnings growth. So to answer your question, might be some downgrades, but still the story remains pretty strong out there.
Okay, so you seem to be still quite convinced. Rupen, you do like financials, right? I believe that's still an area that you're optimistic on. Now, here, this whole thesis about banks falling, I'm wondering if you're reading anything more into it. The Nifty is down about 3% from the peak. The Bank Nifty is down 5% from the peak. And mid-caps are at their peak, as we've been discussing. So is there anything further to read into it? Or would you just attribute it to, technicals, maybe some FPI selling here and there? Or is this fall in the Bank Nifty telling us something that we haven't fully acknowledged and looked at yet?
So Surabhi, in the bank index, if I were to look through the top 3 components into that, right? The largest private sector bank went through a merger process. So, there were a lot of doubts about how it would be treated on the liquidity perspective, weightages and all that. So that has been a relative underperformer for a variety of reasons, because people also want to wait and see how the actual merger will play out, while we are positive on that, but I think that has led to underperformance of the largest private sector bank. In fact, as far as the largest public sector bank is concerned, the numbers and all has been pretty good. But amongst all the banks, large banks, on capital adequacy, while it is still much ahead of regulatory requirement, but it has the lowest CAR of closer to 10.8%. Right, so there is always that thought that whether it'll come to the market to raise capital or not. And the other second largest private sector bank actually had got massively re-rated last year around, so probably it's taking a pause. But from here on, what we believe, banking as a sector is probably one of the few sectors which has a very strong earnings right now, and it's trading at a valuation which is much below its 10-year average. So it actually makes sense to be buying into banking sector per se. And I think one important factor which probably market is not recognizing right now is that with international rates being so high, upwards of 5% odd, so So some of the corporates, blue chip corporates and all, which were erstwhile borrowing it from overseas market, might actually look into borrowing it from the Indian banks, because now there is there is no rate arbitrage out there. So that might lead into a decent amount of corporate growth for the banking system. So net, to sum it up, we are positive on that, and at this juncture, we prefer the large cap banks.
Okay, all right, got that. Rupen, good chatting with you today as always. Thanks very much. A little short on time, but we enjoyed the conversation. Thank you for making time. Well, with that, let's move on. Colgate is the